Let's talk about a situation that can be a total nightmare. You file a joint tax return with your spouse, and then out of nowhere, the IRS sends a bill saying you owe extra money for a tax mistake you didn't even make. But here's what the IRS doesn't always lead with. You might be able to get IRS tax forgiveness through the Innocent Spouse Relief Program. Although I'm a former IRS agent, I'm not here to give you tax or legal advice. Every case is unique, and you should always talk with your own tax or legal advisor. I'm here to pull back the curtain on how the program actually works. Today, I'm going to walk you through an insider's guide to the 4 types of relief and the key deadlines to know. The guidelines around relief can seem complicated, and honestly, they are. There are 4 different types of relief the IRS may consider. First, innocent spouse relief, for when your spouse made a mistake you knew nothing about. Second, separation of liability relief, for when you're divorced or living apart and need to split the bill. Third, equitable relief. And fourth, relief from liability for community income. When you apply for relief, you don't have to figure out which one fits your situation. The IRS will review your information and automatically consider all 4 types of relief and then apply the one you qualify for, if any. Just be sure to focus on clearly explaining your situation and providing the right documentation. That's where professional guidance can really make a difference. When you sign your name at the bottom of a joint tax return, the IRS views you and your spouse as a single unit. This means the IRS doesn't care whose income it was. They can come after either one of you for 100% of the tax, interest, and penalties due. Simply put, the law allows the IRS to collect the full amount from either spouse. You are still on the hook, even if your spouse earned every single penny. It doesn't matter if you were a stay-at-home parent or didn't work at all that year, even if you get a divorce later, even if your divorce decree says your spouse is responsible. It doesn't even matter if a judge orders your ex to pay the taxes in your divorce settlement. The IRS isn't bound by that court order. They can still collect from you. Here's the important part, and the reason I'm explaining this. In certain situations, the IRS recognizes that holding one spouse fully responsible just isn't fair. That's where innocent spouse relief comes in. It's the only way to break that legal bond when things weren't done right. Let's look at what the IRS actually considers when they are trying to decide if you're truly innocent. If the IRS decides that your total tax should have been higher than what was on your return, and if that extra tax is only because your spouse made a mistake or lied, like hiding income or claiming credits they weren't supposed to, and you genuinely didn't know about it, you might be a good candidate for innocent spouse relief. The good thing is it's not all or nothing. Even if you knew something was a little off, but you didn't realize the full extent of the errors, you might still get IRS tax forgiveness for the part you were truly in the dark about. Before we go any further, we need to take a look at the boundaries. Think of innocent spouse relief as a very specific tool. It works wonders for some things, but it's not for every tax bill. First, this is strictly for taxes related to your spouse's income, either from their regular job or self-employment. Here's what you can't claim: your own income. If it was your mistake, you're still responsible. Household employment taxes. If you owe taxes for employees like a nanny or a housekeeper, you can't get IRS tax forgiveness. Business or employment taxes, or shared responsibility payments. So how do you know if you're a candidate for innocent spouse relief? You generally need to hit these 4 requirements. 1, there was an error on the return that caused you to underpay. 2, you truly didn't know and had no reason to know that those errors existed. 3, it would be unfair to hold you responsible. This is where the IRS looks at the whole picture: your finances, your relationship, and whether you actually benefited from the extra money. And 4, you filed a joint return. If you filed separately, this relief doesn't apply because you weren't liable for their tax anyway, unless you live in a community property state. I will go more into community property later. If you're no longer with your spouse, there's a second path called separation of liability relief. Think of this as the IRS unjoining your tax return. Instead of both of you being 100% responsible for the whole bill, the IRS actually divides the understated tax between you and your former spouse. Here's how the split works. The IRS looks at your individual incomes and assets for that year and says, okay, this portion belongs to you and this other portion belongs to your spouse. You then become responsible only for your share. Separation of liability is a shield, not a refund tool. It can stop the IRS from collecting additional taxes from you, but it cannot be used to get a refund for money you've already paid. There are 4 core requirements for separation of liability relief. 1, there was an understatement of tax, meaning the IRS says you actually owed more than what was reported. 2, you didn't know about the errors when you signed. 3, you are no longer married or living together. Now, let's take a moment and define number 3, because no longer living together is broader than you might think. The IRS considers you separate if you are divorced, widowed, or legally separated, or you have lived in separate households for the full 12 months before the day you ask for relief. And lastly, 4, you filed a joint return for the year in question. If you're in a community property state and you filed separate returns but still got hit with your spouse's tax debt, you might still qualify for relief. I'll explain exactly how that works in just a few minutes. There are also deal breakers for separation of liability relief. There are 2 things that will get your application rejected. If the IRS can prove you knew about the understated tax when you signed the return, or if you and your spouse were moving money or assets around specifically to hide it from the IRS. What happens if you don't fit perfectly into the first 2 categories we just talked about? Maybe you did know about the income, or maybe you aren't separated yet. This is where the 3rd option comes in, equitable relief. I like to call this the safety net of the fairness clause. The IRS uses this when you don't qualify for the other programs, but based on all the facts and circumstances of your life, it would simply be unfair to hold you responsible for the bill. You might fit the equitable relief category if you can say yes to these 4 things. 1, you've checked innocent spouse and separation of liability, and for whatever reason, they just didn't apply to you. 2, you filed a joint return. 3, you and your spouse didn't move money or assets around to hide from the IRS, and you didn't knowingly file a fraudulent return. If there was a scheme to cheat the system, you won't get IRS tax forgiveness. 4, based on your income, your health, your education, and your current life situation, it would be a genuine hardship or simply wrong to make you pay the debt. Equitable relief is usually reserved for taxes on your spouse's income. And just like before, those standard exclusions still apply. Things like business taxes or household employee taxes are still off limits. But because this is the fairness category, there are some exceptions where you might actually get IRS tax forgiveness on your own income. These are specific situations where the IRS recognizes that you weren't truly in control. You might qualify for IRS tax forgiveness on your own income if you set aside money specifically to pay your taxes, but your spouse took that money and used it for themselves without you knowing. Or you're only being held responsible because of the laws in a community property state. Or your spouse's dishonest actions or fraud led to this tax mistake or the unpaid bill. Now, the IRS takes spouse abuse and fear of retaliation very seriously. If you signed a return because you were afraid of what your spouse would do, if you questioned them, or if you were a victim of abuse, the IRS can waive the usual requirements. The IRS does not expect you to challenge a tax return if doing so puts your safety at risk. There is one huge reason equitable relief is special. It is the only type of relief that helps you with an unpaid tax bill. Let's clarify the difference because this is where people get confused. Understated tax. This is when there was a mistake or a lie on the return, like we discussed earlier. Unpaid tax. This is when the tax return was 100% correct. The numbers were right, but the check was never actually sent to the IRS. Here's an example. Imagine you and your spouse file your return and it correctly shows you owe $10,000. You give your spouse $5,000 to cover your half and they promise to pay the full $10,000 to the IRS. But instead, they spend that money elsewhere and leave the bill completely unpaid. Even though you did your part, the IRS still sees you as 100% responsible for the full $10,000. In a case like this, the IRS can look at that situation and say, you acted in good faith, you were misled, and it would be unfair to make you pay that debt twice. There are 2 knowledge traps that will cause the IRS to reject your application for equitable relief. Trap number 1, you knew the bill wouldn't be paid. If at the time you signed that joint return, you already knew or had a very good reason to believe that your spouse wasn't going to actually pay the tax bill, you generally won't qualify. Trap number 2, even if you didn't actually know about a mistake, the IRS will ask, should you have known? For example, if your spouse was reporting really low income, but you were living in an expensive home and flying in private jets, the IRS is going to say you had a reason to know that something was wrong. Basically, the IRS wants you to do your due diligence. If the lifestyle doesn't match the tax return, they will expect you to ask questions before you sign. If you had a reason to be suspicious and you ignored it, they'll likely hold you responsible for the tax bill. There's a clock ticking on your ability to request equitable relief, and that clock moves at different speeds, depending on whether you owe money or you're seeking a refund. Scenario 1, you owe a balance due. If you have a tax bill hanging over your head, you must file your request within the time the IRS has to legally recover the tax. Usually that's 10 years from the date they first calculated the debt. However, be careful. That 10-year window can be suspended or paused for certain reasons, like bankruptcy or a previous appeal, which actually gives the IRS more time. Scenario 2, you have a credit or you're due a refund. If you already paid the tax but realized later that you shouldn't have been responsible for it, you have a much shorter window to get your money back. You generally have to request relief within 3 years from the date the return was filed, or 2 years from the date the tax was actually paid, whichever one gives you more time. There are exceptions. If you were in a federally declared disaster area, or if a physical or mental health struggle kept you from managing your finances, the IRS might give you an extension. Scenario 3, you have both a balance due and a credit or refund. The 3-year and 2-year time frames apply to any payments you have made, and the 10-year time frame applies to any unpaid debt. I promised earlier that we'd talk about a special circumstance for those of you in community property states. If you live in one of these states, you might be able to get IRS tax forgiveness too. Let's look at that next. If you live in a community property state, which is Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, you know that the law usually views everything as 50-50. Usually that means you're responsible for half of your spouse's income, even if you filed a separate return. But if you ask for relief, the IRS is allowed to ignore those state laws to see who the income actually belongs to. If you filed separately but are now being hit with the bill for your spouse's hidden community income, you might get relief if you meet these conditions. 1, you filed a separate return, not a joint one. 2, you didn't know and had no reason to know about that specific income your spouse earned. 3, it would be unfair to make you pay for it based on your current situation. 4, you didn't include the item of income in your gross income. What kind of income are we talking about? This relief specifically covers things your spouse earned that wasn't reported, such as their wages or salary from their job, income from a business they ran as a sole proprietor, their share of partnership income, income from their own separate assets, or any other income that belongs to your spouse or former spouse. Basically, if they earned it and they kept you in the dark, the IRS can detach you from that debt. If you're looking for relief from community property debt, you need to move fast. Generally, the IRS has 3 years from the date you filed your return to assess or officially charge you for any taxes you owe. You must file your request for relief no later than 6 months before that 3-year window closes. There's an exception you need to watch out for. If the IRS audits your return during the 6-month relief request period, you will have just 30 days to file your request for relief after receiving the initial IRS contact letter. What if you don't meet the requirements for community income relief that we just went over? If you're stuck with a tax bill that clearly belongs to your spouse or ex-spouse, you can fall back on equitable relief. Remember how we called equitable relief the safety net? This is exactly why it exists. The nice thing is the deadlines for equitable relief are much more generous. You get to follow the same guidelines we talked about earlier. Generally 10 years if you owe a balance, or 2 to 3 years if you're looking for a refund. If after looking at all the facts and circumstances, you believe that your spouse or former spouse should be responsible for some or all of the tax bill, you may be able to request relief from that tax, including penalties and interest. To do that, you'll file Form 8857, which is called Request for Innocent Spouse Relief. I strongly recommend that you get help from a CPA or an attorney to fill out the form. They can help you gather the right documentation and present your case clearly to the IRS. Form 8857 actually covers the different types of relief. And again, you don't have to figure out which one applies to you. The IRS will review your information and determine which type of relief, if any, you qualify for. And FYI, as of 2026, Form 8857 still cannot be e-filed. Also, don't attach Form 8857 to your tax return or file it with the tax court. Instead, you'll need to mail it to one of the addresses shown on your screen. Or you can fax the form and supporting documents to the IRS using the fax number also shown on the screen. If you receive a notice in the mail saying you owe money on a joint return, the clock starts ticking the second that notice is issued. If you owe more taxes due to an audit, you should request relief the moment you realize you have more taxes due. But there is one specific document you need to watch out for: a notice of deficiency. If you get this notice, you usually only have 90 days to file a petition with the tax court. If you decide to go this route, you must raise innocent spouse relief as your official defense right in that petition. Once the IRS first attempts to recover the tax from you, you generally have exactly 2 years to file Form 8857. As I mentioned earlier, there are exceptions to the 2-year time frame for equitable relief in community income cases. So what exactly counts as a collection attempt? The IRS considers the clock started if they took your refund. If the IRS kept your tax refund from a current year to pay off old joint debt and they sent you a notice about it, the clock is running. Court or bankruptcy. If the IRS files a claim against you in court or shows up as a creditor in your bankruptcy case, that counts. A lawsuit. If the government sues you personally to collect the money. The intent to levy. If you get a Section 6330 notice, usually labeled as letter 11 or letter 1058. That is the IRS officially telling you they intend to seize your assets or wages. You've probably heard that the IRS generally has 10 years to collect a debt. Once that time period expires, the debt is legally dead. They can never collect it again. But here's what happens when you file for relief. There's a collection freeze. From the moment the IRS receives your Form 8857 until the day your case is fully resolved, including any time spent in tax court, the IRS cannot legally try to collect that money from you. However, there are two fine print items you must understand. One, while the IRS stops collecting, the meter keeps running. Interest and penalties will continue to grow on the unpaid balance while your request is pending. If your request is eventually denied, you'll owe more than when you started. Two, remember that 10-year expiration date? Filing for relief pauses that clock. For instance, if your case takes a year to resolve, the IRS gets that year plus an extra 60 days added to the 10-year deadline. Essentially, you aren't running out the clock while the IRS reviews your file. You're just hitting the pause button. What happens after you submit Form 8857? Well, the IRS is required by law to contact your spouse or former spouse. They will reach out to let them know you've requested relief and ask if they want to participate in the process. The IRS typically takes 6 months or even longer to review your request. While you wait, do not stop paying your current taxes. Keep filing your returns on time and paying what you owe for the current year. Once the IRS is done processing your form, they will send you an official letter of determination. It will tell you exactly how much relief you've been granted and what your next steps are. Getting that determination letter from the IRS isn't necessarily the end of the road. If you don't agree with their decision, you have the right to appeal. You generally only have 30 days from the date on that letter to file your appeal. Both you and your spouse have this right. If the IRS grants you relief, refunds may be available, but it depends on the type of relief you qualify for. Under innocent spouse relief and equitable relief, refunds are allowed. However, under separation of liability relief, refunds are not allowed. Also, the IRS will only refund payments you personally made with your own money. That means you may need to show proof that those payments came from you. The one exception is if your individual refund was applied by the IRS to a joint tax balance from another year. No additional proof is required in that case. Please keep in mind that refund amounts are limited. I put the refund limits up on your screen so you can see exactly how that works. If you've explored all the options we talked about today and innocent spouse relief isn't the right fit for your situation, there are still other ways to get IRS tax forgiveness. Two of the most common options are an offer in compromise, where you negotiate to pay the IRS less than what you owe, or bankruptcy, which can, in specific cases, wipe out older tax debts entirely. I've created deep dive videos on those topics to help you decide which path is right for you. You can click on one of those videos right here on the screen to keep learning. I wish you all the best on your journey to financial freedom.